Now this is the second approach in measuring GDP. We now start income approach, and we are part 3 of chapter 6, we can call it. In the previous video, I explained the expenditure approach, and you noted that the circular flow diagram helped us a lot of making a distinction between income approach and expenditure approach, and how they are dual of one another. So the national income is the aim of measuring instead of GDP, when we go for measuring the aggregate of economy with the help of income approach, we end up measuring national income rather than the gross domestic product. Later, we're gonna find a relationship between national income and the output. I already told you that the aggregates are many, and we said GDP and GNP, NDP, NP, GNI, and NNI, or this one is also called national income. So once you start from the income approach, so this I stands for income, whereas the P stands for the product. So if you aim to measure the aggregate with the income approach, it ends up measuring, and with overall addition or aggregation will give us the national income. So national income is like we ask the people how much they earn, how many factors of production we have. So this is income becomes payments. Payments to factors of production. And how many factors of production we have? I just write it here. We have labor, we have capital, we have land or resources, land, and we have entrepreneurship. And the payments to them, we already told you that the payments to labor is called wage. The payments to the capital is interest. The payments to the resources or land is rent. And this one is profit. So if we can add them together, this is basically is going to give us the national income. So these are the dollar value of payment to physical amount of factors of production we have in the society or in the country. But there are some technicalities which are explained in the textbook. So number one, compensation of employees. So these are basically wages. This includes wages, salaries, and various supplements or the bonuses or supplements which people, employers, contributions to social insurance and pensions funds, for example, is another compensation. Superannuation, for example, co-contribution of the employers for superannuation, they might come here. Paid to household by firms and by the government. So it might be actually you're working for the government or you're working for as long as you are offering your labor, your time, then the payment for that time as an employee, it's called compensation of. So this is equivalent of that W which I mentioned. Oops. This is equivalent of that W. And then we have proprietor's income. Okay, so these are payment to the what if you don't work for someone else? You are having your own business, or you have not part of the corporate economy. So unincorporated businesses is the title of the payments is called proprietor's income. Similar to the W, but let's call it W prime. Together is compensation for the. So authors, copyright, the money you receives because you have a patent, something which is not registered as a company, but it brings you income. Okay, so these are in the income approach is classified as proprietor's income. Still payment to the labor. This is still payment to the labor. Rental income, this is payment to the land, and we called it R already. Okay, so the income received by property owners in the form of rent. It's can be property, or it can be anything which is related to the land. Its payment is referred to the rental income. It's like you are renting a house, okay, and the landlord receives the rent. So that's one type of rent. Or you are leasing from the government a business, like running a 7-Eleven in the metro station. So this is again the payment is for the property, and hence it's the rent. The government may actually sells part of their national endowments, like they may lease the right for mining gold in Rub al Khali, if there are any gold over there. So then the people who are receiving this franchise or this right to go and mine, they're paying something. This might be actually from the private sector. The private sector may give their resources to be exploited by a specific company. So that is also the payment for that is classified as rental income. So anything related to the natural resources or land or properties is classified as rental income. Then it comes to corporate profits. These are payments to the entrepreneurship. Entrepreneurship receives the profit. And this is corporate profit. Actually, the proprietor's income is the profit for non-corporated ownership. So it's basically they are paying themselves for their innovation and for this. So proprietor's income should be also considered as a different way of corporate profit. Corporate profit, if you have a company and then you are hiring land, labor, capital, and then you are selling your item and the difference is your profit. So it's a takeover take away from doing the business. And interest is the payment for the capital. Interest is payment for the capital. And there are some other payments also, which is related to the type of job which the government is doing. Government number one is subsidizing, so that's a negative income for the government. But sometimes they generate income by basically putting tax on goods and services. This tax is different from tax on income. It's not income tax, so it's called indirect tax. Indirect tax, whatever you buy from the market, the government had nothing with that, but the government, for every transaction which a commodity is being sold, they're taking a portion of that, so top up the indirect tax on goods. So net amount, indirect tax minus the indirect subsidies, if there are some subsidies for goods and services, together this is a part which appears in the income approach. Another thing is net business transfer payments. So transfer payments is basically somebody pays another person, or government pays the pensioners for although they're not working. Although they are not working, this is called transfer payments. So net transfer payments by the business to others, this is especially by the businesses. It's considered as, where is the transfer payments of the government goes? The government, it's in the income tax. It's become negative income tax. So in the circular flow diagram, if I bring it back, the circular flow diagram here, so the government actually here is receiving money or is paying the transfer payments. This is governmental transfer payments. But the firms and corporates also may pay transfer payments to some other corporates, or so those kind of transfer payments is coming here. Net business transfer payments. It is like some companies are supporting research for helping the to cure the cancer or the HIV/AIDS, things like that. So the transfer payments is like a gift which is being given from one party to another party. This is in the business contribution. So that generates income for some. So that is considered as another components of income approach. And surplus of the government enterprise. Income of the government enterprise is also may run in a financial basis. Like they might actually build a power plant, and then although they have collected tax to build that, but the enterprise is making some profit and generates income. This income is been going to the government budget, and hence it's considered as surplus government enterprise. So altogether is reflected in the income approach. By the way, most of the developing countries, they don't calculate the income approach. They only have the value added and expenditure approach. Unfortunately, Oman is also not measuring the income approach for the national income, because it's a little bit requires systematic discipline of how to collect the data. By the way, sometimes it's based on the surveys, comprehensive surveys, and a statistical error becomes so large that they're unable to publish it. So once we explain the relationship between income approach and see, it is all based on the collection of the data. Once you go to the people and ask them that how much they have, the books they have spent, they show it, and it's very accurate. And people are usually much more honest about their expenditure than about their income. So there would be some disparity between the value of the aggregates performance of the economy from the income approach to compare it with the expenditure. Theoretically, we said that they should be identical, but because we are going from different angle and we are asking different questions, usually once you ask how much you earn, people are becoming actually not telling the truth and says, what do you need my income? So it has to be very systematically recorded so as the government can accurately calculate the national income, whereas in the developing countries, this is not the case. So all the compensation of employees, proprietors' income, corporate profits, rental income, net interest, plus what is related to the government and non-governmental additional transfer payments or subsidies, taxes, it's appearing here. And altogether, it's giving that how much the national income is. And the percentage, you would see that the largest percentage is often related to the salaries and the payments to the workforce. Okay, so this is 2017 income approach, whereas the this is the income pardon. This is the 19,000. It was the GDP. So you see that they are not equal. They're not equal. So from the gross domestic product is nearly 20 trillion, whereas the national income for the US is about 17 trillion. So there is some differences, and we shall find a way to, if I give you one, you can calculate the other one. So that's parity between the income approach, because see, there we are doing the gross domestic product. So it's not national. First, we have to convert the gross domestic to gross national, and then from gross national product, do some calculations until it will make the balance between the national income and the expenditure approach calculation of the aggregate. So that is easy to say that if we do the expenditure approach, or income approach. So in income approach, we calculated national income, which is also called net national income. National income and net national income are the same. In the expenditure approach, we calculated gross domestic product. So, and then we can also calculate the net domestic product if we take off the depreciation, or we can calculate the gross national product or net national product. And if you have net national product, it should be with some statistical discrepancy this should be approximately equal. Okay, so the statistical discrepancy can be positive or negative, either way. This might be bigger than that or the other way around. So this is very natural once you are calculating the same concept from different angle. We put it in the statistical discrepancy. So we are not gonna explain how we can reach from one side to another. So here we have net national product, NNP, gross national product minus the depreciation, a nation's total product minus what is required to maintain value of the capital stock. And statistical discrepancy, as I told you, and the personal income. So the personal income is the total income which is belong to the households before the tax has been deducted, by the way, before the tax has been deducted. So we can say that from the gross domestic product, if you have, we want to reach from here to here, you can either go here and then come here, or you can go here and come here. So let me tell you, if you have gross domestic product and you want to calculate net domestic product, easy. Gross domestic product, you take off, because this is gross, this is net, depreciation. You need to know the depreciation. But from gross domestic product to go to the gross national income, the difference was like this. Gross national product is gross domestic product plus, remember, recipient from overseas minus payments to the foreigners. So this is the way that you can calculate. And if you want to, if you have gross national product and you want to calculate this, or you have this to want to calculate this. So let me do first this one. So net national product is gross national product minus depreciation. So because the difference is between G and N, so the difference is depreciation. How about you want to come from here to here? So net national product, the difference is in the domestic, and so you have to use this approach. So you would say that it is equal to the net domestic product, but this is domestic, you want to make it national. So you have to add the recipient from overseas minus the payments to the foreigners. Factors production, payment to the factors of production, foreign, payments to the factors production, working overseas. And this is shown. And once you do this, you can say that net national product is equal to the national income plus minus statistical discrepancy. So this is basically true, that the net national product is equal to the national income. So let me show you in the slides. So you have the GDP, which was $19,390.6 billion. And now you are adding plus that R, which I told you, are recipients of the factors income from the rest of the world. So this is the money which our citizens works overseas in the rest of the world. So you add that. This is your money. It's your national money. And minus payments to factors to the rest of the world. So these are the foreigners taking their money to their nation. So that is minus. And then it gives you gross national product. So I told you that GDP plus the R minus the P is going to give you the gross national product. And this is now 19,000. It's some, for the US is approximately the same amount. And then because this is gross, you want to calculate the net. So you subtract the depreciation, and then this becomes the net. Now it gets closer to what we had it from the income approach. From the income approach, we had this. From the expenditure approach, we get this. So the difference is actually the statistical discrepancy. I hope that this is now making it life very easy for you to understand how they are interrelated. All the aggregate measures, which is GDP, GNP, NNP, and NI. Another things is that after the disposable income, I already defined something called personal income. Personal income is that the income which is not going to the government, is not going to the corporates, it's going entirely to the households. So becomes NNP minus the income for the non-household. The leftover is called personal income. And from personal income, if you deduct the tax which goes to the government, it remains as the disposable income. It means it's in the disposal of the families to do whatever they want. Part of the personal income is going to go to the government. The people are unable to use it. So disposable income is after tax income, which I also showed it in the circular flow diagram, if you remember here. So this is basically after tax. So part of it is actually goes to some of the government, or so it's national income come here, and then you take out whatever is gonna go to the government and firms as the non-household revenue. The remainder is the personal income, and the personal income after tax, personal income after tax is giving you the disposable income. This flow diagram is approximate, so it's not very accurate. Some textbooks have done it excellent, like McGonnell is giving a precise definition in the US system, but I am drawing an approximate. So disposable income is personal income minus the income tax. And then we noticed that in the circular flow diagram, so the disposable income is either consumed or saved. So what is the saving? The saving would be the personal saving with the amount of disposable income that is left after personal spending is done. So it is disposable income minus the consumption expenditure. The leftover is called personal saving. And the rate is the division of the saving divided by the disposable income. So the ratio is giving you the rate. So you have the national income, and then you subtract the amount of national income which is not going to the household. So that has been taken out, and that will give you the personal income. And then you deduct the income tax, and that will give you the disposable income. And after disposable income, you know that how much is the C. This is the C, remember? This is the C. And we said that the disposable income is consumption plus saving. So if you are subtracting from the disposable income that the leftover and personal interest and transfer payments. Transfer payment is basically made by the household. So people are giving a gift to others. So here is negative. And personal interest payment, if they are borrowing and they have to pay the interest. So these are going to be additional subtract. And after all those done, which was a part of the negative saving. So these are negative saving, minus S1 minus S2 and plus S saving. So the personal saving would be the personal consumption expenditure minus personal interest payment minus transfer payments made by the household, and this becomes their saving. So if we want to simplify, we would say that S is disposable income minus consumption. Okay, that's the easier way to do it. And this divided by disposable income, this divided by the disposable income divided by this is the percentage which has been written here. So in the US is about 3%. Yeah, Americans are not savers. If you calculate this rate for Chinese or Japanese or Germans, this is larger. There is a reading here, Economics in Practice, which I want you to read. The GDP is one of the most important invention of the 20th century. Actually, it's sitting next to marvels of human invention like electricity. It's such a vital importance. So do think critically, like the way that Simon Kuznets did in inventing this concept. Okay, I will stop the part 3 over here, and then there are 2 more things to say. Number 1 is the distinction between nominal versus real GDP. Another one is the problems which the GDP have. So that's problem number 1, that never use the nominal. And the problem number 2, in the beginning I told you that GDP is not reflecting the well-being. So what may be causing that the GDP undermines the accuracy of the GDP in reflecting the overall performance of an economy. So these 2 will come in the part 4 of chapter 6. Thank you.